It's let me talk a little bit about today, and then I want to introduce our speaker for today, and she may have a few words of introduction about herself as well. In any event, this is our last day, as everybody knows. We're going to be looking at extractive industry contracts today, starting out with a discussion by Viola Taras, who works for IGF. She will talk about standards for these contracts. And so she'll be with us a little over an hour. And then we're going to have a break, and we will have three speakers, I believe, 2 or 3 speakers from HSF, the big law firm. And they're going to go through with a look at actual contracts and negotiation of contracts and what have you. And finally, for the last half hour, maybe a little bit longer than that of the day, we'll have an open discussion about the issues relating to contracts and negotiating contracts. But I think because this is the last day, it would be fun to have an open discussion about the issues that came up during the entire week. So if people have thoughts about that, or they have particular issues they want to address, they should bring them up then. Viola, the process is that people ask questions in the chat box. I usually monitor that. Sometimes they raise their hands, and so we are likely to interrupt you as we go forward. A few people will actually just, they feel they have to get something said, so they will go ahead and say it, although it's a little hard sometimes because most people are muted. In any event, we do enjoy having a discussion during the talk, so don't be surprised if that happens. And that usually makes for an interesting conversation, actually. So we do encourage it. That said, why don't you go ahead and introduce yourself, and we can get underway.
Thank you so much, John. Let me try put up my slides, and then I can start with the introduction and the course material.
Perfect.
Perfect. Are you able to see my slides in front of you?
I can see them just fine.
Perfect. So good morning, good afternoon, everyone. My name is Viola Taras, and I'm glad to be with you today. As John mentioned, I work for an organization called Intergovernmental Forum on Mining, Minerals, Metals, and Sustainable Development. The Secretariat is hosted by another organization called the International Institute for Sustainable Development. And at IGF, what we basically do is to support countries. So our main stakeholder, or we work for the governments to support them achieve sustainable benefits from the mining sector. So we work exclusively on the mining sector and not on oil and gas. And we work on different issues from legal and policy framework, which is very important, going into financial benefits, going into environmental and social impact assessment. We also touch on the ASM sector, and we also have a thematic area on gender, which is very important and should be cross-cutting across all the themes we work on. So how do we support governments? We support governments by doing in-country assessments of their laws and institution framework. We support them with capacity building. So we would offer training on different issues. This can be broken down into one-off trainings or technical assistance. So these are long-term capacity building sessions where we can have a country supporting them for 2 to 3 years on different issues that they have approached us to support them on. And we also develop policy guidance, again, for different countries to support them on different issues. So for example, we have a policy guidance document on how government should handle incentives, how they should on tax treaties. So we have different policy documents. This can be translated. This has to be translated into English, Spanish, and French because of the different governments. So our reach is beyond Africa to Latin America and Asia. And also we have conferences where we bring in governments and other stakeholders to participate in discussions on the mining sector. So that's basically what we do at IGF. A bit about me before I go to the agenda. I'm an economist by training. I did my undergraduate at the University of Nairobi, so happy to also be part of this discussion that UON is collaborating with ISLP. So I did my undergraduate in economics, and I finished my undergraduate program around that time when Kenya had just discovered oil in Turkana in 2008, and there was a lot of interest in building capacity on the stakeholders to support the extraction of this oil. So I started my career at the National Oil Corporation of Kenya, stayed there for 5 years. And at that time, I also did my master's in oil and gas economics at the University of Dundee. I moved from the National Oil to Oxfam in Kenya, again, specifically working on the Turkana oil project, where we worked with communities to ensure that they have a say in the project. And then after that, I joined IGF. It's been 2 years now with IGF, where now my role is really looking at the mining sector and looking at tax-based erosion and profit shifting. So those are the tax issues that we support governments to ensure that they achieve financial benefits from the mining sector. So that's a bit about my organization and a bit about myself. And now let's get into the meat of the program today, where I've been asked to talk about model mining development agreements. So I'll start by explaining what are these model mining development agreements, and the session that comes after my session is useful because then it goes into the negotiation aspect. So I'll discuss what is a mining development agreement, what are some of the benefits, what are the contents of a model mining development agreement. It would be great to hear from you, from your different countries. If you have this in your countries, what are the issues that you have seen? Are these transparent documents? What are some of your recommendations? So I welcome you to stop me. I want this to be very I welcome your engagement at any point. I would like us to have a conversation and not me sharing materials. So on the agenda, I've divided this session into 2 parts. So the first part, we just go into the basics of really what is a model mining development agreement. Let's shorten this for this purpose of this presentation. We'll shorten it to MMDAs. What are the benefits of MMDAs from an investor point and a host government point, knowing these are 2 important stakeholders, and for us to achieve benefits from the extractive sector, that these two stakeholders have to communicate and they have to be happy. And then I'll open it for questions, and then we'll now go in part 2, we'll go into the contents of the model mining development agreement and some of the recommendations for host government, because they're the ones who are in charge of developing this document. And here I'm going to pick most of my recommendations from my colleague was part of a committee with the International Bar Association, where they looked at some of the different model mining development agreements for different countries, and they came up with one template. So at the end, I'm also going to share a link of that template. We only have 1 hour or less, but so I've picked issues that I think are relevant or important, but there's a lot more issues in that template, and it will be useful for you to go in, to delve into that template if you want more information on that. And then again, we'll have general questions. So I welcome you to stop me. I know I've put two areas where we're going to have questions, but feel free to stop me, especially if you need clarity and you need me to stop and slow down and explain the different issues clearly. So let's start with.
You can slow down. You have an hour and 15 minutes.
I have time?
Yeah, you have plenty of time, dear.
Okay, that's fine. I will definitely slow down. So let's start with part one, where we now delve into the definitions of model mining development agreements. So what are these? So first of all, I'd like to just share with you that a lot of mining countries use contracts and agreements between the company and the host government. There has been a push to move away from contracts and agreements. And you know most of the reasons why, because again, these contracts are not public documents. We don't know what's been hidden in there. From an administrative point, a country that has several mining contracts, it's hard from an administrative point for all the tax administrators or the Ministry of Mines to have a keen visual perspective on what's happening in each contract. So there has been an industry push by industry, like general, having all the stakeholders wanting to move away from individual agreements and contracts to generally having relying on mining codes, mining legislations in countries. So that has been the general conversations. But still, even with that said, we see now a lot more countries are continuing to sign agreements and contracts between the government and mining companies. So there could be different reasons for that, and there could be different reasons why this is a good thing. First of all, is that most of these legislations are old, and because this is a sector that is changing, especially on the social and environmental front, you always would want to have an agreement or a contract to supplement what is in the legislation. So that has been one benefit to continue having agreements and contracts. So let's look at what really now is a model mining development agreement. So this is a template used in negotiations between the national government of the host country and the mining company. So it is not the signed contract. So you have a template where you try as much as possible, and it's developed by the national government. So you have a template where as much as possible, you try to figure out everything within the mining value chain, where you need to agree between you, the government, and the mining company. So things in terms of what taxes are we going to charge? What is the area for development? For how long will this mining company be in your country? What are the infrastructure that this mining company is going to be entitled to use? You have to make decisions on what are the rights and obligations of government, what are the rights and obligations of a mining company. So as a country, you sit back and you look at the mining value chain and see what are some of the issues that you and the mining company have to agree on, and then you create a template. So then that template will now, normally it's a public document. It's in the Ministry of Mining website. And now at this point, when a mining investor comes in, either through a licensing round or a fast come, fast served method. So these are ways to get a mining company to invest in your country. So once you get this mining investor coming in, now you negotiate. So you use this template, which you have already sort of figured out the issues that you need to agree with the mining company. And so you sit down and say, okay, from this template, now let us negotiate. So in this template, we said we are going to charge royalty. So how much royalty are we charging you? In this template, we've already envisioned that we need a timeline for you to develop this resource. So you agree, is it 10 years? Is it 25 years? So now the specifics of the different issues, then that is what you negotiate, and that's what now you sign in a contract. And my colleagues are going to speak now about the negotiations of now the actual contract. But this is just a template, so you will not see in the template saying that royalty will be 8% or the mining company is in the country for 25 years. So there will be the provision to allow for the discussion on timelines, but it will not say how, what's the timeline. So this is really a template, and this is a government trying to figure out what do we need, what are everything that we need to ensure that we successfully extract a resource, that an investor is happy, that the national government is happy, that the local government is happy, and that the community is happy. So then this template is normally in a public document, and then now from that is where you negotiate and actually have now individual contracts. So then, as I've mentioned, that it's useful because it can be used to supplement already what's in the legislations, that there's a lot of changing aspects within the sector in terms of taxation, environmental issues, and social issues. So these would be best placed put in agreements or contracts, but also it's useful for lawyers who are tasked now with drafting agreements, that they don't have now to start thinking about the language of these contracts. They have a template which they can use as a starting point and an agreement between the government and the mining company. So that's really what a model mining development agreement, and that's different from the actual contract. So negotiation doesn't happen here. Negotiations happen now in the next point, where now a mining company interacts with the national government to get an agreement for the extraction of a resource.
You know, Viola, I had a question, and maybe you'll reach it later, but when you have these contracts, and that, let's say the legislation specifies a range of royalties, and the contract ends up saying it's 7% or some such percentage, but the contract itself does not speak to how you determine the price of the product, so to speak. And I wonder whether there's a side agreement that does that, how that, or is that in some of the agreements, how that determination will be made? And if it is in the contracts, is there a model provision for how that works?
Thanks, John. Yeah, so John is speaking to a specific section of the MMDA, which touches, for example, on financing. And I'll come to that in part 2, where we see what's in this financing section of the MMDA. It's really the fiscal regime, the currency to use, the royalties, the provision for royalties, where a country has already determined what are the taxes and non-taxes that they're going to charge. And they also would make reference. So this template is also useful because it will earmark, or it will provide, so for example, it will say that the royalties will be determined, the actual percentage of royalty will be determined in the contract, and then it will make reference to, for example, a transfer pricing regulation. So we have other regulations that have been established by the country, like a transfer pricing regulations. You have, for example, the income tax. So there are other subsequent sub legislations which work together with the MMDA and the contract. So you'll find when they're discussing the royalty and the price to use, they say for the price, we will refer to the sale agreement, or we will use, so the model mining contract will establish that in here, but we'll say it will refer to the sales agreement, which was developed by the government for the mining of gold or for the mining of copper. So the good thing about this template, it will make reference to other additional documents that you have to look at. And for others, it might show it here, but unlikely, because this is really a template, it will make reference to other additional documents that have to work together with this template.
Okay, great.
Any other question on the definition of MMDAs.
We're loving the presentation. Please continue.
Thank you, Mark. So still on the definition of MMDAs. So there is no one standard MMDA across the mining sector globally. And the recommendation is not to have one. Why? Because first, countries vary in the level of legal policy and regulatory development. So you can't look at all the countries that have minerals and have one MMDA. It's impossible, it's a lot of work, and the document at the end of the day might be useless. So the recommendation is there's no one standard MMDA. The point is not to have one, but also in some countries, you'll find that there's one MMDA, but in some other countries, because mining commodities vary in geology, production processes, markets, and economies, in some instances, you would find more than one model mining development agreement, for the reason that, again, if a country has diverse minerals, they're treated differently. You think different laws would apply for them, like artisanal small-scale mining, large-scale mining. There might be a push to have different MMDAs for that specific reason, because you want this tool or this document to be as much as possible very practical. So no standard MMDA across the mining sector globally. But another thing that I also want to clarify here, that an MMDA is not an exploration agreement. So the mining value chain, you start with exploration. So here there's a lot of uncertainty. You don't know how much reserve is there. You don't know if as a mining company you want to go on and develop this resource. So with the exploration, there's a different agreement that governs the relationship between a mining company and the government with regards to exploration. The MMDA is useful once development begins, all the way to the upstream end of the mining value chain. So that is the production and decommissioning and or what people call the mine closure. So that's where the MMDA is relevant, not so much for the exploration, because you can, once you have exploration and you have explored and say that I want to go on and extract the resource, then now you have to approach the government and have a discussion. But during the exploration, there would be a separate agreement, and it's probably not very detailed, because here you're not even sure that you're going to extract or proceed with extraction. So the MMDA is from the development all the way to the mine closure. And it is also not a community development agreement. So you will notice again, as I mentioned to John's question, that it will make reference to some documents, and one of them is a community development agreement. It will make reference to an environmental and social impact assessment plan, but it is not, that's not the detail. So a lot of countries have development, community development agreement, separate documents. They have ESIAs that are separate documents. So the template would have a provision for a mining company to establish a community development agreement with the community, but that's as far as it will go. It will not go into the details of what is contained in the community development agreement. So those are some of the distinctions to know. Okay, are you going to get everything in the model mining agreement? No, you'll not get details on the community development agreement, and you'll not get the details on things to do with the exploration. So there's a question from Ange, is it preferable to have one model for each type of mineral or one common model for all minerals? So what I have seen, and maybe colleagues can tell me from your countries, what have you seen? Most countries I have seen, they only have one model mining development agreement. And why is that? This is also time consuming. Like I will share with you a link, which is looking at a template, you have to figure a lot of things. And most countries will just have one, but again, it will not go into the details of the different commodities. So for example, they will say it will depend, it will look at the, for example, look at the regulations concerning copper for details of how royalty is going to be calculated, or it will make reference to now the other documents that relate to the different minerals. So what I've seen with a lot of countries is that they have only one mining development agreement. So the next slide really look at what are we trying to achieve by having a model mining development agreement. What we are trying to achieve is it's a template that will help to get to the negotiations and come up with a development agreement. So now this is the next part. So you have a template. The next stage is actually going for negotiations and and signing an actual agreement. So this MMDA helps to figure all the issues so that when you go to the negotiations and actual signing of the agreement, you have an agreement that is going to be favorable to the investor and the host government. What does the host government want? The host government wants to maximize the contribution of the mining sector for its countries, for its community, for this generation, for the future generation. So that's what the host government wants to achieve. Investor, on the other hand, they want to sign a contract that will give them security, that will give them stability around the investment that they're going to bring into a country. So this sector, the mining sector, the extractive sector in generally are very cash hungry, that the capital costs are very high, operating costs are very high. So, and then if an investor is supposed to put in such huge amount of costs at the start, there has to be some form of guarantee that you will help me stay in this country, give me the right conditions for me to be able to extract this resource 5-10 years later and make sure that I recover my costs and also get some form of return. So this is why you have to, as a country, it's important to have a template, but also if you don't, you have to make sure that when you're negotiating for the contract, you have to look at the mining sector and look at from development, from the actual production to mine closure. Have you already figured out what should be the right of the investor? What is the investor supposed to do when it gets to mine closure, and not leaving it out until it's the mine closure point and like, oh no, who's going to fund the rehabilitation? It's not in the contract. We didn't discuss this. And you see the investor by then has already left or is about to leave. So these are some of the things that will help you to look at when you're developing your template model mining development agreement to ensure that you have provisions for all these issues. So the benefit of having a template, or your starting point is to have this template, but your end goal is to ensure that at the end of the day, you have a successful mine development agreements, which will benefit the host government. And by host government, I'm talking about the communities involved, the local government, the future generation. And for the investor, it has to ensure that the investor has gotten back its money and also a return on top of that. That's the eventual that you say that we've had a successful development agreement. So that's the first part where you just talk about definitions of the development agreement, what it is, what it's not, what is the benefit. I'll stop here if you have questions, and then we will go now to the contents of the model mining development agreement. And maybe I'd like to hear from you in your countries. Do you have model mining development agreements? Are these public documents? I would love to know.
Folks, does anybody have a question? I've looked at, I guess, Viola, from my limited experience, I do not consider myself an expert in this, but I've looked at a couple of countries. I don't know whether I call them model mining agreements, but mining agreements. And they follow a pattern. It's not entirely clear to me sometimes whether you have the mining model mining agreement and then what happens afterwards vis-a-vis the actual contracts that are entered into. Some just parallel the legislation and others are do not seem to do so, or may not be available and you can't even tell what's going on. I don't know, the people on the in the group have some experience with this or questions about it?
I know Kenya, we have model petroleum sharing agreement, and I think it is, yes, it is online. And that's not very different from what we see now in the actual contracts that are signed between the petroleum company and the investor. Now this is filled on terms of the document is completely filled in terms of how much corporate income tax they will pay, what is the rental fees, what is the surface fees, the contract will last how many years. So for me, for Kenyan context, and I'm talking about the petroleum sector, that we actually have a model production sharing agreement, and that is an online document. And then the contracts that I've seen with the petroleum company, it's very much similar, only now that it has put in the details of how much, what is the actual timeline, what is the actual fees to be paid, the tax to be paid.
Okay, I don't see a hand up. Everybody's quiet this morning, but hopefully that means
we have a hand raised by 2 hands
oh,
actually.
we do
So,
have 2 hands
yes.
raised. Yeah, you're absolutely right. You're better at this than I am, Viola. Okay, let's see.
Aggie, you can go ahead.
Angie?
Hello, can you hear me now?
We can hear you now, yes.
Sorry. Thank you, Viola, for your insightful presentation. Maybe I will share experience on Burundi perspectives. Previously, we used to have investors who would come with their own mining agreements, and they sit with the government and start the negotiation from there. So those contracts used to be unbalanced. Yeah, because they would come and say, we are used to deal with this and this in other countries. So we would prefer that your country join this contract and accept these terms. But recently the government has changed his own way of doing things, and it has started to draft their own mining agreement, yet they are not public, and they're not even published when they are signed. But we only know that we have contract, companies have contract, but they are not public at all. So it's the sector is not really transparent. And I think we need to improve some of our practices.
Thanks a lot. Yeah, that's very common. I think even in Kenya, we struggle a lot with contract transparency. We have working with Oxfam, we really went to the government and we wanted the contract for the oil, the Turkana oil, to be published for everyone to see what's in there. And by the time I left, I don't think until this point we have that contract available. And what was even annoying us was that Talo was the main operator, I think still is the operator for the Turkana oil. And in Ghana, where they were actually producing, not even in the development stage where they were producing, the contracts that they signed with the government were public documents. But in Kenya, they said, no, I don't know if it's the government or the investor, but they were not public documents. So these are some of the things that I think with the government, you have to ensure, like, is it something within your law? A company will come in and say, okay, does the government in the law require us to publish contracts? Yes, they will not say no to that because the law already says that, yes, all contracts should be published. So I think it's a point for government to ensure that all these things are thought before and they're put in law, and then companies will publish these contracts.
Another problem we've seen on transparency, and I don't think the woman that works on this particular issue is with us today. But sometimes the contracts aren't even given, the parliament in the country may have to approve a contract, not just have the government enter into it or execute it. And sometimes they aren't even given the contracts much before they vote on it's kind of presented to them and say, okay, here it is, vote on it. And so the transparency issue not only affects the public and civil society organizations, but other pieces of the government as well.
Mm-hmm.
I don't know, Zola, you had your hand up.
Yes, John, thank you. Hi, Viola,
Hi.
loving this. So my question, I know we're talking model mining development agreements, but I was just wondering whether the IGF has started working on a model agreement for renewables, or just, because I'm originally from Namibia, and we're currently looking at, green hydrogen production. And I was just wondering if the IGF is working on or has worked on an agreement, a model agreement for that sector.
That's a very good question. So no, so far we've not received a request from our any of our member countries to support them with mining model mining development agreement for the renewable sector. The last country that we worked with to develop an MMDA was Ecuador, but they have actually not even used that model mining development agreement. So we don't know what, again, with governments changing and new governments coming in, and they have different clues of how they want to do things. So that's the last country actually we supported. They were very much interested because of the demand that they were getting from the mining sector. And they also have a couple of critical minerals. They were really interested to have a model development agreement. But so far, we have not even seen them using it.
Yeah, Zola, let me just, I actually have a little experience in your question. There is an organization called the Green Hydrogen Organization that I've worked with and still am working with, and they are creating a model agreement. And indeed, there are like 9 chapters to it. I helped write the chapter on taxation. The interesting part about the production of green hydrogen is that unlike minerals or oil and gas, it's not an exhaustible resource. And so it's not exactly the same as a mining agreement, because you're not looking at a resource that has a beginning and end point to it. It's inexhaustible. And so the question really is, how do you deal with that? Do you create a royalty stream? Exactly. The country that's producing it in Namibia, I think the thought is that the green hydrogen be produced for export. And so how do you share the proceeds between the company that's producing it, the off-taker, and the government? It's an interesting question. It's a little bit different than what we're talking about here. Okay.
There's a question mark for the purpose of learning. Might you have a sample MDA that you can share with us? I'm not sure if Uganda has one. I might need to follow up on that. Yeah, so during the break, I'll share with you. I know Kenya, we have a model petroleum sharing agreement, and I'll also share with you this template that was developed by the International Bar Association. Yeah, so I'll do that during the break. They're
Okay.
all online. Yeah.
Great.
Yeah, so let's go to now the next session. So these are what are the sections of an MMDA. So again, I'm referring to this, what my colleague Howard Mann did with a couple of other colleagues and looking at different model mining development agreements. As we've said, there's no one standard format, but what they developed this template looking at different other model mining development agreements. So what I'm going to share with you is what they found in majority of these MMDAs, but again, in some countries, you'll find that they have included other issues. So not to say that they're wrong or they're not relevant, I'm just looking at what majority of these development agreements have. So they have a definition and interpretation section, and I'm going to talk about it and say why it's important to have a definition and interpretation section. They have a section on the tenure. So this is looking at for how long are these mining companies in a country, and what is the development area. So clarification on that, very important. It has a financial segment, which I mentioned a bit, also has a lot of things from the fiscal regime all the way to the currency and who are you going to pay these taxes that are to be paid. So also tries and much as possible and covers anything on the financial aspect. And then it has a section on the rights and obligations. Again, these are two players. What are the rights and obligations of the government? And this is here we're talking about national government, because like going back to my definition, this is actually to be signed or to be discussed between mining company and the national government. But we will see there will be reference to the local government. So what are the rights and obligations for these two parties who are entering into an agreement? And then lastly, we're going to look at other terms and conditions. Not to say that this section has the less important things. You will find it has other like important issues for these two players, but they would put these sections at the end and they would call it other terms and conditions. So these are generally the typical sections that you'd find in an MMDA. We will go one by one to see what are the main issues that are in these sections, and we can again discuss if you've been able to see a mining development agreement or a petroleum one. Would be good to also hear, get your take and tell me what you've seen in this. So the first section is on the definition and the interpretation. So what's in this section? So this section really is the definitions. So they will go one by one defining the terms that are used in that specific development agreement, and which again will, if it's used for the actual contract, the terms that will be agreed upon between the mining company and the government. So this is a section which really defines everything. And you might think a project is something that, yeah, a project is actually the mine project, but there is more to it. Is a project just the mine alone, the infrastructure surrounding it, the pipeline that's going to transport the commodity? So it really goes to define what these things are. And what you're trying to avoid is a case, or you're providing clarity for these things which are going to impact on the taxes to collect, which is going to impact on the right and the obligations of these two parties. So it's really important to, at the start, to define some of these terms which seem obvious, but this will lead to complex arbitration cases between government and the investor. So also you need to define who's a state official, what are minerals, what is the mining area. Another thing that's not commonly used in these documents or in contracts is that a mining investor is going to follow good industry practice. What is good industry practice? So that you need to clarify all these issues at the start, and there's a mutual understanding between the two parties. When we say good industry practice, what exactly do we mean? So for example, I picked this one where they define what is a tax law. So this, for this definition, they say the tax law would be the applicable law of the state, but not the local government, pertaining to any tax and any subsidiary and associated legislation or regulation. So for this specific country, they need to acknowledge, okay, these are only laws by the state and not the local government. And you will find for another country, it might be different, that it will actually be the state and the local government. So it's different, not saying which one is right, one is wrong. But my point here is it is important to define these definitions or these terms, which seem very obvious, but would differ from one country to another. So that's the definition. And then now you go to the interpretation. So interpretation is more slightly different from the definition. So interpretation, you're looking at referencing, for example, I got to, which I'd like to share with you, that the singular includes the plural and the vice versa. So for example, when I say project, when I have the plural version projects, are we meaning the same thing? Is it different? Another would be clarification. If I'm using past tense and present tense, could they mean the same thing? Are we talking about the same issue? So those are the nitty-gritties which has to be decided between the mining company and the investor, to ensure mining company and government, to ensure, again, there's clarity, there's mutual understanding, and we are hoping to get a successful project at the end. Again, a reference to a court. Are we meaning any court can, for example, when I put this in the Kenyan contract, does it mean I can go to the Tanzania court? And I mean, yes, you said court in the agreement. So here again, they refer and they say, okay, by court, we mean the court of the state. So it has to be a court within the Kenyan jurisdictions. So these are the important issues that they try to clarify within the definition and the interpretation section. And again, I've mentioned this, but I want to pause here and say, why is this important to have clarity on these definitions and interpretation? First is to have a mutual understanding between two parties, for both of us to understand when we say a project, when you say the mining area, what do we mean? And to have clarity. So I'll give an example on one of the things that we are dealing with within the tax team at IGF, that we have I don't know if you, so we have something called ring fencing rules. So with ring fencing, a government has to have a regulation or a rule with regards ring fencing. So how does ring fencing apply? So ring fencing is more of a government trying to put a limitation to ensure that an investor is not bringing in costs from another project or another mine that is, for example, in a loss making, that is making a loss, and transfer those costs to another mine, which they also own, and that is making a profit. So what they're trying to do is reduce now the profit from the profit-making mine, so that now they can collect, they can pay less taxes out of it. So those are basically what we call ring fencing rules. And in the definition of ring fencing, so the government would put in or would qualify what they mean by ring fencing. So in this definition, they say, our ring fencing rules relates to the limitation on consolidation of income and deductions for tax purposes across different activities or different projects undertaken by the same taxpayer. So if you go to your definition and you need to clarify what is a project. So if you've not clarified what the project is, the investor might say, oh, but my understanding of a project is this mine and this infrastructure that I have built to support this mine. So for me, those two things is one project. And so I can offset the losses from the infrastructure into the profits I have of the mine, and I'm going to pay less taxes. So you now see the importance of clarification. And a lot of countries that we are working on ring fencing issues, it boils down to how do they define a mine? How do they define a project? And what does the ring fencing rule states? So those are the importance of this definition and interpretation section.
I wonder how detailed that can get. That must be, could get extraordinarily detailed, I would think, in some cases. There's a question in the chat box as well.
There's a question from Rachel. Ring fencing rules in the extractive sector is in tandem with specific sources of income provisions in the general tax code. I agree that you'll find the ring fencing rules is in the the provision for ring fencing, for example, is in the general tax code. And it will have, for example, this definition and say a mine. So how do you define a mine? And that's why I say these documents communicate with each other. So what is a mine? Where can we find the definition of mine? Investor said, oh, I use the definition of mine from the contract I signed with you. So yes, the provision, the ring fencing provision is in the general tax code, but the definitions which is contained in the law on ring fencing is from the contract that they signed. So what I'm saying is it's important for these documents to communicate to each other. You use them together and not one saying something different and the other saying something else. Any questions on definition, or we can move to the tenure? So the next session is on the tenure. So the tenure refers to, there's a lot of materials under the tenure section, but what really the tenure section looks at is the development of the mining area. Again, looking at the mining value chain is that development section before you start production. And this is again, very critical that at the start, you have to look at what is the term of this agreement. And here you look at the timeline. So one of the things that is discussed under the tenure section is the term of the agreement. And under the term of the agreement, we are looking at the timelines, and also we are looking at the scope of mine development and access rights. So it's very important that the contract puts in the timelines for the project. And this is important for both the investor and the state. So the investor, they want to guarantee that their rights will not expire until they've recovered their costs. Again, as I mentioned, with the extractive sector, it is the costs that go in later and you get your revenues at the end. So the investor wants to see, okay, you've put 25 years. Generally, I don't see that by 25 years, I'm going to extract this resource. I would need 30 years. But on the other hand, the state might say, if I give you 30 years, and there's no progress, that means I have time is money. I'm giving one investor the exclusive right to hold on to this resource for 30 years. And what if there's no progress? So you find again in the contract, they would put a timeline. So for example, they'd say this project would run for 25 years. So typically mining projects go for 20, 25 years, but there would be a caveat saying that after 5 years, we are going to review and see what development has been done. Then we can renew. So there might be a provision for reviewing, but also there might be a provision for appraisal to see what has been done after specific timelines. And these timelines, you've seen, it's very important. The investor also want to have a timeline, but also the state wants to ensure that someone is not sitting idle on a resource and I could have given it to another investor. So that's why timelines is a very important discussion. And then the next is on the scope of mining development and access right. So here it's the extent to which the investor is allowed to displace other use of resources and land. So for example, in Turkana, in Kenya, where we had this oil development, they don't come into an idle land. They come into a land that has people, has pastoralist communities. So there's a lot of grazing that's going on. So the MDA and subsequently the contract will define what is the scope of the mine development and the access right. What is the mining company accessible to? What is within its right, for example, but also it's important to know what are the likely impacts of the mine, for example, on the community, on the vegetation, on the animals. So it's really important to define the scope of the mining development and access rights for the different reasons that I've highlighted. So two important issues in this slide is when you're discussing the tenure, this is really the development of the mining area, and it's important to clarify on the term of agreement what are the timelines. We've seen how it's important for the investor. We've seen how it's important to the state, but also looking at the scope of the mining development and access rights. The investor needs to know what is within my access. Where would I need to pay for the right to use? What are the likely impacts of the mine? Because now I'm not only using this area, but I'm also using areas surrounded to this mine by a certain radius. So then if you're going to map out an environmental and social impact assessment, it's not only the mine area, but you also have to look at a certain radius because you also have the access right to this area. So that's why it's important to clarify these issues.
In practice, Viola, to what degree do civil society organizations or community organizations have some input into the scope? Would seem there would be quite an impact on certain geographic areas in the country.
Yes, that's very important. And I want to maybe also just to mention, so the scope, it would be outlined in the contract. But now when you're carrying out an environmental and social impact assessment, so what the government would require in some jurisdictions that you not only, you don't focus on the mine area, but you have to go further and factor in, for example, an area 50 kilometers from the mine project, so that it would be defined in the environmental and social impact that, yes, this is a mine area, but as far as the ESIA for this project, the agreement between us and the government is to go farther beyond 50 kilometers. These are the towns, and they would provide the map in the ESIAs. And by law, these ESIAs are meant to be documents open to the public, and because consultation has to take place. In fact, even to be translated in the local language, so that if everyone has this document, so they would have a map where they would say, okay, the ESIA is covering this gradient, these downs, passing through this because of this. So you'd find that in the ESIA or some of the subsequent documents that the scope might change, but because you're looking at the environmental issues, which not only will not apply or will not affect the mine area, but the surrounding areas. And civil society should have that as part of the consultation process for the ESIA.
Okay, interesting.
Perfect. So another issue within the tenure that relates to the development of the mining area is the exclusivity and the legal title to minerals. So we've had cases where a mining company would come in and they were coming in to get, for example, let's say copper out of a minefield, but they start digging, they start extracting their copper, they find another mineral. The practice is a lot of these mining companies do not declare to government that, oh, we have found another resource which can be monetized and this is money. So that's why it's important, again, for monitoring government officials to be monitoring and see, okay, what is really being extracted? Because normally you would find the contract would say that this is a contract between the state and the mining company for the extraction of a specific mineral. So in any case, if you found something else, the law has already covered the government, because we will say, see, the exclusive right has been given to you to mine mineral A and not B. So if you also want to mine mineral B, we will need to tax it differently, and we will need, again, to factor in what is the impact of that mineral. So this is something that's very important. I know for some countries, for example, the ore might contain different minerals, and that would be highlighted in the contract. But for some, you find that they found totally different minerals than what has been signed. So it's really, a government here is covering themselves by saying you have the legal title to mine mineral A. If you found something else, then we have to come to an agreement and see, do we need a separate taxing regime for that? Do we need a separate environmental and social impact assessment mapping for that? So that's why it's really important to clarify on the legal title to the minerals. But it is also useful for the investor, because the investor needs to know what is the legal, I need to clarify what is the legal title for me to use this land, because normally when they're fundraising for the extraction of these resources, a lot of them use equity and debt. So equity is their own money or their shareholders' money, but debt, they have to go to the bank, and they have to go to the bank and show, I have legal title over this land to develop this resource. So this is me using this to raise funds. So, and you'll notice throughout this conversation is for every of these issues within the contract, it's important for the investor, it's important for the government for different reasons. Again, we've had for some countries that there is the conflict between ASM sector and the large scale miners, where you find the ASM cropping into your mine area. So again, if there is support at the end of the day is case or there's a conflict between the two, we need to know who has the legal title to these minerals. And lastly, and then I'll open it up for questions, it's in the use of illegal or improper use of minerals. So nowadays there is a conversation about a lot of people are using minerals to fund conflict, to fund terrorism. So it's also important to know at this point where for example, at the mine area, who has the legal title to minerals. When the mine is being transported, who has the legal title, in whose hands is it, or who's responsible for ensuring that then the mine minerals are not used to finance armed conflict. So those are some of the reasons why, again, within the contracts, very important to ensure who has the exclusive rights, who has the title, both important for the government and for the mining company.
Does anybody have a question?
Okay, I'll go to the next section. I'm still on the tenure, but now talking about the obligations prior to construction. Again, it's important when you have now this template model agreement that you look at all these issues, you put in the language right, you put all the necessary documents right, so that when you start negotiation, it's not figuring what documents do we need, what time do we need them. It's already thought in the template, and then now for the negotiations, it's easy now to go from there. So here, when you look at the obligations prior to construction, the obligations are different from one jurisdiction to another, but at least what I've seen, it covers the feasibility study. So within the feasibility study, it's looking at the estimation of the reserves, what is the investor's mine plan, when does the investor plan to start production. This helps the government to monitor and see, okay, you said you're going to commence production in this year. When that doesn't happen, the government needs to know why has that not happened. And even during the monitoring process, this is what is the feasibility study. We are looking at this amount of resources. Is there any change? What's the explanation? An investor also, it's within, as part of the obligations prior to construction, is to have an environmental assessment and a management plan, which also look at how to prevent and mitigate environmental harm, social impact assessment and action plan, which look at, again, the adverse impacts of the mining projects on persons living and around the project area. And investor is also supposed to produce a financing plan. As a country, I would want to know, how are you planning to finance the extraction of this resource? So this vary from one government, one jurisdiction to another. But the key recommendation when handling these documents, or what you ensure that should be in your contract, is that these documents should be prepared or at least verified by an independent third party who will ensure that good industry practices are reflected. So most of these minerals are in developing countries, and they don't have well or clear legislations which are tuned to industry practice. So a lot of developing countries say, this is our legislation, but also make sure that you apply the international standards. For example, IFC, we have the IFC performance standards, which talks about, for example, if you're conducting an environmental and social impact assessment, you have to consider variety issues, which a lot of developing countries have not considered. So the purpose of, you have to clarify that, yes, you have to look at our laws, but also beyond our laws, look at good industry practice, what is to be done. So these are some of the recommendations that when you have these documents, good to ensure that you've said that they need to follow good industry practice. And remember, in the definition, you need to explain what do you consider as good industry practice. You should ensure.
Oscar had a practical question.
Yeah.
You know, the resources of many of these developing countries is pretty limited, and so they don't, you know, the number of inspectors you have to enforce provisions or monitor provisions may be limited.
And it's not, yeah.
Yeah, he didn't know what the situation in Kenya was in his country, Uganda. It's a fairly limited resource in terms of inspectors.
Yes, and this is not only very common to a lot of countries that we work with in terms of the capacity, not only the capacity to monitor the mines, but also to ensure that you're carrying out the audits, that you're picking issues at the right time. So a lot of issues we're working with is in the capacity, the lack of capacity, enough people. So in Kenya, there's we and I working with the petroleum sector, that we would find that there would be monitoring, that the technical people would go to the mine and monitor. But now it's debatable how frequent it is. How do they even capacity? They might go to the field, but do they know what they're looking out for? Because most of the investors, you have to be very careful what exactly you're doing. So, but also we found, we also used to have this practice of attaches, of sending technical people to be at the mine site for a long period of time. So there's little you can do with monitoring once in 6 months, but also we had this practice of sending attaches who would work or who would be at the mine site for a long period of time. So that can help with that as well.
Okay.
Yeah, so continuing with these recommendations that, you have to ensure that this, within the law, you have specified that the ESIAs and the social impact assessments are public documents. So the investor knows that, okay, once I've developed this for consultation, I need to put this out in the public because the law says yes. And so also you have to ensure that you are telling the investors within the law that there has to be full consultation with the local government, with the community, but you also have to outline what is the approval process. Again, in case the investor says, oh, you're delaying in giving us feedback, say, okay, what does the law say? This is the approval process. That once you've finished with an social impact assessment plan, that it has to go for public consultation. And then after that, if there are comments from the public, you need to address them. If not, then it comes to us and we have 30 days. We give you feedback for feedback. After feedback, if we are all in agreement, then it is signed. So these are important issues that within the agreement, you've laid them out so that it's not a blame game. Like the government is not working hard to ensure that this project is ongoing, or like investor says, oh no, the government does not require us to give you these documents for consultation. So here, a country, you need to cover yourself to ensure all these things you want are in the law. Okay, so we've done the first part, which is definition and interpretation. We've looked at the tenure, and then the third thing, which are in this mining development agreements, model mining development agreement, is the financial area. And this is a huge area because it does not only stop at what taxes to be paid, it looks at what point to be paid, who is paid, at what point is a certificate acknowledging that you have paid. So it looks at all the detailed issues, and that's why it's important when you have a model mining agreement, you look at these issues, you factor in, you have a discussion on them. You already know that when you're negotiating, you have to tick point 1, 2, 3, and 4. So this really helps our government because under negotiation, you're thinking, oh, we don't have time. We need to get a contract up and ready. What are we looking for in this area? Then later you realize, oh, we didn't mention this in the agreement. So having a template agreement helps you to cover everything. And under financing, you'll be able to detail, for example, what are the non-tax payments to be paid? What are the taxes to be paid? So here, the template would have the fiscal regime. So they would say, we'll collect a royalty, we'll collect corporate income tax. And here, when a government is looking out at the developing the fiscal regime, you have to consider a lot of things. And one of the advice, some of the advice that we give to our member countries is you have to ensure that you have a fiscal regime that is neutral. It will not deter investment. It is progressive, that you will get more revenues with high prices. That is very simple, even from an administrative point, that it is stable. That is what investors want, something that's why if you have a progressive regime, that it will move with high prices, you'll get high revenues. With low prices, you're getting less revenues, then it is stable. You're not going in and changing some of these regimes every now and then. Like we've had countries like Zambia. Zambia has changed a lot its regime. And again, it's not a good point from a stability point. Investors would get worried like, oh no, should we go in, should we not? Again, robust to profit shifting, you have to ensure that from an administrative point, how easy it is for you to administer that so that the mining company does not take advantage of the loopholes. And also looking at the timing of revenues. So a lot of countries would prefer to have royalties at the start, because at the start they are able to get revenues, but also now when the project is now making profit, that they are now able to collect corporate income tax. So this is a good time for a country to look at how do we want a fiscal regime to look at? What are our objectives? What do we want for these revenues? And then you put it down in your template. It also looks, another good point, and I think Rachel mentioned this, is there is a general tax code. So this document has to work together with the general tax code. So things like the corporate income tax are in the general tax code. And then in there, you'd find that the Ministry of Finance would say, this is a corporate income tax for these kind of industries and these industries. So you have to ensure that the general tax code is communicating with the contract, because you don't want a conflict of, okay, so which corporate income tax are we collecting, that one or this one? And this would be able to say, okay, if there's a conflict, which law is superseding or should we look at? So these documents really have to communicate. I think in one country, Sierra Leone, we found that the mining contract was not communicating with another document. And then one of the investors are like, okay, which one are we following? So these documents have to communicate with each other. Another issue that they look at financing is on the insurance. If there's a requirement for the investor to take out insurance on the mining project. There's also a requirement on the financial records. Which accounting standards are you supposed to use? So these are the discussions that should happen at the contract level. In terms of currencies, which currency should I pay? Is it the dollar or is it the jurisdiction's currency? In terms of the financing, you want to give a prescription to the company, or we need to have a discussion, or we need to negotiate the debt to equity ratio. Because again, we've noticed with some countries that mining companies would take advantage of the debt, and especially if the debt is coming from a related party. And so with transfer pricing, they will make sure that they take advantage of getting high interest debts from related parties so that they pay more in interest, and then so as not to pay taxes in the country. So you have to be careful. You have to ensure there's the provision to negotiate the debt equity, or the template should say, okay, this is the minimum. So when we are negotiating or when you're signing a contract, we can negotiate, but this is the minimum that we go for. So these are the financial aspects. Is now you're moving into the development, you're now looking at the production. How would the financing work, and also trying to make sure that you've covered everything, even in terms of what accounting standards you're using, where the financial records placed, who should receive them, how often should they be prepared. So this is very important for both the company and the government.
Viola, if you could finish up in another 4 or 5 minutes, it would be great. I don't know whether you can do that or not, but we're running a little late, that's all.
Yeah, sure. I need just 4 minutes and I'll be done. So the next, the fourth aspect that are within this model templates is the rights and obligations. Again, it has to be very clear what are the rights, state rights, what are the obligations. Some of the rights for the state would be they have a right to inspect the mining area, that they should not be prohibited from going into a mining area. But then again, you have to add the caveat that it is at its own cost, at its own risk. But these are some of the issues you have to put in the contract in advance, or else now there'll be problems where like, oh, you can't come in, we're doing this, come after 2 years, oh, we can't allow you at this point. So you have to ensure you're covering yourself as a country. You also have the right to audit the company books and records and accounts. Going to obligations, these are what the government is obliged to do. So approve permits required for the mine project, not to give priority, but to ensure where possible that the process follows for approval. So again, we've had companies saying, oh, they've been delaying approvals, there's been delays in permitting. That's why our project is not producing on time. So you have to ensure it's within the law that it has to be approved through the process, and we're obliged to do that. The government is also obliged to ensure that the land is available. So land is normally a very hot issue, and where you would want government to come in and help with the negotiations of land between the communities and trying to move communities. So government says, yes, I know I will need to do this. I'm obliged to do this. It has to be within the law. With the company as well, there has to be rights and obligations. So the company, for example, has a right to establish and maintain a security force to protect its staff. That's, for example, one of the rights. And another obligation, it would be, for example, obligations regarding the labor, health, and safety standards, that they are obliged to adhere to applicable law, and also good industry practice in as far as the labor and health and safety standards of the mine is required. So there are a lot more rights, a lot more obligations that you have to put within your template, and which goes into the contracts. And the last section really talks about the other terms and conditions. As I said, it's not meant to say that this is the least priority, but there are a lot more issues that have been put under the other terms and conditions, which as a country and company you have to agree on. And this can relate to the obligations of the contractors and the subcontractors. So a lot of mining companies, they give work to contractors and subcontractors. So there has to be a law that's governing the contractors and subcontractors. One of them is government saying that, yes, you can use contractors and subcontractors, but that does not exempt you from the obligations that you have within the agreement. So those are the important issues that government have to cover themselves, that yes, use contractors, use subcontractors, but that should not exempt you from the obligations under the agreement. Other issues like confidentiality, and which comes to the transparency issue that we were talking about earlier. The government should say, okay, this contract has to be public. What you're doing, the ESIAs, the social impact assessment, are public documents, except, for example, health records of your employees, confidential legal matters, including advice from attorneys. With these descriptions, it helps the discussion later, like, should a contract be public? Should it not? It's more of what does the law says in terms of what should be confidential and not confidential. And then other things like cooperation, dispute resolution, again, telling them there has to be a mutual agreement. For example, if there's a dispute, what is the first thing? Is it to get arbitration? And if not, how are we going to settle our disputes? So again, this has to be factored in the contract, easier to do it before the dispute actually arises, very important. And also other issues like the surrender and termination. So at one point, can the company says that I am surrendering the right to develop this mine? And what are the issues that can allow the government to terminate this contract? So if you fail to do this with this a given period, or if you become bankrupt, then we can terminate your contract. So all this has to be within the contract. And really, my key takeaway point here is with the model contract, what you're trying to do is that you're trying to establish a mutual understanding between the host government and the mining investor. It is better to discuss these things at the start than wait for it to happen, which then can stall a project. And in terms of it might affect the stability or perception of a country with other investors. So it's really important to have a model mining development agreement. We've mentioned why it's important, but then if you don't have a model mining development agreement as a country, it's really important to take time when you're negotiating to cover all these issues that we've highlighted here. With that, I will say thank you so much.
Viola, wonderful presentation. Thank you very much. We are going to take a break. We're running a little bit late, but not too bad. So it's about a little after 3:20 East African time. I think I have my, I always have trouble with my time zones, but I think that's right. In any event, so why don't we come back at 3:35? That gives us a little less than 15 minutes. And I believe the HSF people, at least most of them, are ready and with us. And so we'll convene at 3:35. And Viola, please stay around in some fashion. You can ask questions, but in any event, we'd love you to
Yes.
participate in the ending discussion. Okay, everybody,
Thank
we'll
you.
reconvene in a little less than 15 minutes. It's always nice to know that we have the speakers present. For now you're going to manage your own slides, I believe. Is that correct, or am I incorrect?
Yeah, that's correct, John. We've got the slides and we will run through them. If that's okay with you.
Yeah, no, that's great. That's fine. Yeah, I didn't introduce you, but the prior speaker, you probably heard a few minutes of her presentation. Viola Harris will be with us, and she will join in the sort of questions and answers at the end of the session. She's from IGF, and as you can probably gather from what you listened into, we went through the different provisions of the model agreement. At some point, I'd like to get into the practicality of how you determine the transfer pricing and what that, it's nice to say the royalty is 7%, but if you don't know the price of anything, it could be 7% of nothing or 7% of a very large figure. So, evidently that detail doesn't find its way into the general agreement always. Okay. I have, I always want to get my time straight here, but I have 2:35 here, or in East African time, 8:35 New York time. So I think it's time to begin. Patrick, you might introduce yourself and the people that are going to speak with you. That would be great.
Sure, thanks, John, and good afternoon, ladies and gentlemen. My name is Patrick Layden. I am a partner in the corporate team at Herbert Smith Freehills, based in Johannesburg, South Africa. I specialize in natural resources and energy across sub-Saharan Africa. I'm joined today by my colleagues Justine Sweet and Ernst Muller, as well as William Lotter. So Ernst, if you could perhaps or bring up the presentation and we can kick off.
Sorry, it's coming, Patrick. I just need to get the right screen.
No worries.
Just checking if it's projecting.
Not yet.
It's coming. You're up.
Perfect. Okay, so today's session is entitled Negotiating Extractive Industry Contracts. As I mentioned, I'm joined by my colleagues Justin Sweet and Ernst Muller. If you go on to the next slide, this just gives you an outline of what we plan to cover in this session. The different types of mining regimes, mainly to contextualize the environment in terms of which these contracts are entered into. And then we'll take a look at government contracts, private contracts, and then my colleagues Justine Sweet and Ernst Muller, who are specialized in ESG and ESG-related matters, will take you through how the ESG is looked at and how it's become prevalent in today's negotiations as far as contracting is concerned. So, Ernst, if we could perhaps move on to the first slide, which is your different types of mining regimes. And then the next one. So broadly speaking, there are two different types of mining regimes which we see on the African continent. The first one is a licensing regime, and then the second one is effectively your MDA and your concession agreements, where you effectively enter into contracts with the state. So if we deal with licensing regimes, first of all, what you've got in this situation is the state is the regulator and the licensing authority. Private parties apply for a license and the state either grants or refuses the license. There's generally a clear set of criteria or requirements to be met. And if these criteria are met, generally the minister or the granting authority has limited discretion in either granting or refusing that license. So there is little or no negotiation when it comes to the terms of these licenses. They are generally standard template licenses, and they are issued on a basis, and they all look very similar. So issues like free carry, royalties, local participation, and other fiscal provisions are generally regulated under the other relevant laws. So this kind of licensing regime system is normally implemented in a country that has fairly developed and sophisticated laws as far as royalties, local participation, and fiscal provisions are concerned, so that there is a reliance on these other laws to feed into the mining laws. So examples of jurisdictions where the licensing regime is used include South Africa, Botswana, and Namibia. And the table on the screen at the moment just gives you a basic idea. I'm sure you're all very familiar with these different types of rights or licenses issued, but effectively you've got a reconnaissance permit, which is your early stages, like a desktop study looking at the geological maps and photographical surveys. You then got your prospecting right or exploration license, which is normally granted for a limited period of time and allows you to actually conduct the act of prospecting, drilling boreholes, taking out core samples in order to try to find a mineable deposit. Once that mineable deposit is found, you'll normally apply for a mining or an exploitation license. And in most jurisdictions, your exploration or prospecting right will give you an exclusive right to apply for your mining right or exploitation license in relation to the same mineral and the same area of land to which your prospecting right relates. And that sort of gives you that security of tenure, that if you're going to put in all your money and you're going to invest a lot of capital during the intensive capital stage of prospecting, that you've then got this exclusivity and comfort that if you do find something, you've got the exclusive right to apply for a mining or an exploitation license. And then you also have small-scale mining permits or effectively artisanal mining permits, and that's for your smaller projects, your sand mining, things like that, which are normally far less onerous as far as the requirements are concerned in order to obtain those licenses. So obviously, I'd like this to be an interactive session, so please feel free to drop your questions in the question box. Alternatively, at the end of this section, before I hand over to Justine and Ernst, I will open it up to questions. So please do feel free to interrupt me.
Yeah, people, Robert, people pop questions in the chat box, or they'll raise their hand. Occasionally they may shout out, but typically raise their hand or put it in the chat box.
Great. Okay. So then the second regime we have is the concession agreement and the MDA regime. So under this regime, the state enters into concession agreements or mine development agreements with private companies. A concession agreement is a license issued by a government or quasi-governmental authority to a project company, granting the project company the rights to develop, construct, and operate the mining project. Should be viewed as an umbrella agreement from which the project company receives the rights required to develop, build, and operate the mining project in exchange for undertaking various responsibility and assuming various risks. This regime is usually used in circumstances where the regulatory framework is not as developed as in other countries which use the licensing regime. And I think, as Viola mentioned in the previous session, is that a lot of these things like local, the local content, employment, fiscal policies, and things which are not necessarily regulated to a great extent are then included in these agreements. And we'll go into a little bit more detail on these concession mine development agreements, bearing in mind that Viola has gone into quite a lot of detail in the last session. So certain countries such as Tanzania, DRC, and Zambia employ a hybrid model where you've effectively got your small-scale mining activities regulated under a licensing regime. And then when it comes to mining activity and mining development, that's regulated under these concession agreements and MDAs. So if you could please go on to the next slide, where we're going to look at the government and private contracts. And I think what's equally important is to give you some further context. So we've looked at these different regimes, but then we need to look at sort of the stages of mine development in order to understand what exactly are these contracts regulating. So this diagram here sets out a very basic overview of the stages of mine development, going from the early stages of geoscience, which is your desktop studies, through to exploration, discovery, then actual mine development when a deposit is discovered. And then only towards the end do we get to production, and then we have finally reclamation or effectively mine closure. Now, what's really important to, sorry, so you can just go back. What's really important to think about here is that the life of mine and the time period that at which these mines run. So if we go from sort of geoscience to production, so we're going from the early stages to when mine actually starts to produce minerals. I mean, that can be anywhere from 5 to 10 to 15 years. So we've got a long lead time, and during that time, we're putting in a lot of capital, or mining companies are putting in a lot of capital just to get to that production stage. And then from production to mine closure, again, you're looking anywhere from 5 to 75 years. So what we're trying to do here, and what makes it so difficult in a contracting sense, is to enter into contracts that are going to stay relevant and stay fair and stay reasonable over a really long period of time. And on top of that is actually balancing the rights of all stakeholders during this period, which is obviously extremely difficult. So that leads me to the next slide. And this slide sets out, some of the key role players and stakeholders in the lifespan of any mine. So right in the beginning, right in the middle, in the yellow, we have the mining or petroleum company and its project. And you can see all these relevant stakeholders and how they all fit in. You've got customers, suppliers and contractors, local and indigenous communities, you've got employees, you've got host governments, you've got the various intergovernmental departments, you've got international organizations, organized labor, and all of these various stakeholders need to be considered in the various contracts that these mining companies enter into. And so if you can go to the next stage, sorry, the next slide. So here we look at the first set of contracts, and those are the government contracts. And I won't go into too much detail on sort of the mine development agreements. Viola in the previous session went into quite a lot of detail, but I'll just try to talk about some of the key issues and some of the things we're seeing in practice. So the mine development agreement is not entered into at the exploration phase. I think what's quite important is that the exploration phase is capital intensive. You're not producing any revenue, and therefore it is highly, there's a lot of risk involved in the exploration phase. And so it's only really when it gets to the mineral deposit has been discovered that then the government comes together with the private investor or the mining company, and they look to build on that relationship as far as taking that mine forward to a producing project and for the life of the mine. So some of the clauses we see are standard clauses are in relation to 10 years duration, exclusivity, so legal title to minerals. So for example, if you take the South African model, for example, the landowners do not own the minerals that are found beneath their land. So although you have private land ownership, the landowners are not the owners of the minerals. Rather, the state is the custodian of all minerals. So the state grants you a license until those minerals are actually extracted from the ground or mined from the ground pursuant to the mining license that is granted to it. Those minerals remain under the custodian of the state and then only become owned by the mining company once they are actually extracted from the ground. So if you look at sort of the financials, I mean, this is your sort of fiscal basket. You've got your annual rental, your royalties, your custom duties, taxation, financing, etc. And so those are really critical things that investors will scrutinize when it comes to negotiating your mine development agreement.
Hey, Patrick, I have a quick question. In the U.S., the individual landowners own the right to minerals. Are there any states in Africa where that's the case? Or are all the states in Africa where the government owns mineral rights?
John, it's a good question. I think the majority of states or jurisdictions in which we work, it's generally the state owning the minerals rather than the landowners. But I'm interested to know if my colleagues have any different experiences. No. Yeah, so I think in most cases we've got the situation where the state has taken over custodianship or ownership of those minerals.
Yeah, that, puts everything in perspective, because where it's the other way around, then you're negotiating with a private landowner. So it's a very different situation.
Yeah, absolutely. Absolutely. I mean, South Africa, I think up until 2004 had a similar mining regime to in the States. And I think it's certainly seen as something where at least the states in sort of mineral resource African jurisdictions have the ability to control the licensing or the concessions if those minerals are owned by the state rather than the private landowner.
Yeah. Okay.
Thank you.
Yeah. Perhaps I can just add that to me, it seems very much aligned with environmental principles or environmental international principles which are developing, which is that states are generally the custodians of natural resources. And obviously minerals are natural resources.
Yeah, agreed. Vance, if you could move to the next slide, please. So these MBO concession agreements also deal with state access to the project. Importantly, in a number of jurisdictions, they'll deal with ownership by the state. So the state takes up equity in the mining company, and then coming or flowing from that equity is obviously participation on the board of the mining company. And in some circumstances, that equity has a free carry, meaning that it's a non-funding equity, or at least non-funding during certain stages. The company has various rights and obligations, and I mean, in particular, these normally govern the use of local goods and services. So a certain percentage of your procurement spend for goods and services must be bought by from or by local citizens. Also, importantly, your community development, making sure that there is development of the community or employment and the training of community members. Something that's been fairly controversial in the past is obviously your stabilization clauses. And effectively what these are is clauses that you put in, normally relating to your fiscal obligations or your obligations around the payment of taxes and royalties, which effectively stabilize those agreed provisions for a period, normally the life of the mine. And that's to give the investors certainty and protection against changes in law, where there may be a change of law which results in those royalties increasing. And so this offers protection. Now, I mentioned that it is fairly controversial because in the past, these stabilization clauses and agreements around them have on occasion been agreed very low, particularly in sort of when we have a commodity price booms and the governments of those host jurisdictions feel like the stabilization clause are unfair or unreasonable when they were agreed to at the time. And then ultimately what happens is essentially these governments can then request to reopen these agreements, which obviously has significant concerns for investors looking to come into those countries. Just an interesting one, and I won't go into the detail, is on the sort of dispute resolution and arbitration. It's something that we normally see is quite heavily negotiated. The state will normally always push to have arbitration or disputes heard through the local courts. Investors are obviously concerned that if they take the state to court in that jurisdiction, that they may not get a fair or impartial hearing. A lot of times what happens is through negotiation, you end up agreeing on a neutral territory or a neutral country as the seats of arbitration. in relation to these agreements.
Yeah, I wonder, ISDS arbitration has been become somewhat controversial. And maybe we should save that for the discussion later, but when you combine it with a stabilization clause, you know, you can get into some fairly heated discussions about it, I think.
Yeah, absolutely, John. And so if you could move to the next slide, please. So I think, as I've mentioned, you've essentially historically had this battle for these, what is effectively finite resources. You know, these are resources that are situated in these African countries that are limited. Once they're mined out, they're mined out. So there was this, or is still this continuous tussle between government, private investors, and stakeholders like communities to all make sure that they have some sort of benefit deriving from these mineral resources. And historically, what you've seen is you've seen investors coming in, and normally these are investors that are backed or heavily financially backed. And so they can employ the best lawyers and accountants and geologists. And so what invariably happened is a little bit of an uneven negotiating position. And some of these contracts were ultimately, as I mentioned, were agreed at the time, but over a period of time, it actually, the governments, a number of governments felt that these terms were actually unfair, and that they should be renegotiated. And of course, opening up binding agreements to renegotiation, of course, makes investors nervous, and is not great for investors' certainty. So the Organization for Economic Cooperation and Development, over a sort of effectively a 3-year period from 2016 to 2019, set about having these multi-stakeholder consultations in order to develop a set of principles which they believed could at least create an even negotiating platform, or allow the parties to come in and have common criteria in mind when negotiating these contracts. And so in 2019, they published the Guiding Principles for Durable Extractive Contracts. So the Guiding Principles set out 8 principles and supporting commentary that host governments and investors can use as a common reference for future negotiations for enduring, sustainable, and mutually beneficial extractive contracts. So I've paraphrased these 8 principles below, and won't go into too much detail. We'll just touch on them briefly. So the first principle is durable extractive contracts are aligned with the long-term vision and strategy defined by the host government. So what they're effectively saying here is that the government should have a long-term strategy on these things, and that it needs to, from the outset, get buy-in from all its intergovernmental departments to make sure they're all aligned on the vision going forward. The second principle is durable extractive contracts are anchored in transparent, constructive, long-term commercial relationships and operational partnership between host governments and communities. So the signature of the MDA or the concession agreement is just the starting point, and it's the start of effectively what is to be a long-term relationship. So it's all about managing the expectations of the stakeholders, from the government to the private investors and the communities, to make sure that everyone's aware that that there are these cyclical, that commodity prices are cyclical, there are the ups and downs, and that everyone needs to share in these ups and downs. The third principle is durable extractive contracts balance the legitimate interests of host governments, investors, and communities with due account taken where relevant of the specific rights of affected indigenous peoples recognized under applicable international law. So this is effectively what, before the term ESG came to prevalence, I think mining companies have for a number of years been the social license to operate has been front of mind. And a social license to operate is, as you probably all know, is not necessarily requires strict adherence to the law, but rather goes broader than that and looks at your local communities, and actually you go beyond what your legal requirements or your statutory requirements may be, but look to engage communities and to uplift communities. And that is an important aspect of negotiating these MDAs. So durable extractive contracts seek to optimize the value from resource development from all stakeholders, including economic, social development, and environmental outcomes. I think I've chatted a bit about the social outcomes, and I think the importance is to grow the experience and grow the technical capabilities and the economy of the local or of the jurisdiction in which you're operating, or at least the local community. And the things that mining companies generally and host governments look at is what kind of infrastructure can be put in place, not only in relation to the mine, but in the surrounding communities. Can we build hospitals, schools? How can we really engage with the communities? And also, I think for many years, governments have been really trying to look at creating sort of downstream beneficiation industries that can survive after a mine has been mined out. And there is a strong push in a number of African countries to ensure that the mining companies assist the local citizens to ensure that these downstream industries are developed during the life of the mine. So thanks, Ez. If you can move to the next slide. So principle number 5 is durable extractive contracts are negotiated based on the continued sharing in good faith of key financial and technical data to build a common understanding of the performance, main risks, and opportunities of the project throughout its life cycle. And I think the importance of this point is that information should be shared, whether it's financial models, etc., so that there is no distrust between the parties, that the investor is withholding information. And I think if you can play open cards and you say, look, these are our models, this is what we expect, but there's a high amount of risk, I think, as everyone knows in mining, and that models will generally change fairly regularly. And so the important of here is the ongoing sharing of information to make sure everyone is well versed in and up to date on what's happening and where the risks lie and where the opportunities lie. So principle number 6 is durable extractive contracts operate in a sound investment and business climate and should be underpinned by a fair, transparent, and clear legal and regulatory framework and enforced in a non-discriminatory way or manner. So I think many of you will be familiar with the Fraser Institute. Every year it interviews mining companies and posts the key risks or the key risks to investing in mining jurisdictions, and then it ranks countries by their level of investment attractiveness. And time after time, the CEO of mining companies say one of the critical things to consider when investing in any mining jurisdiction is regulatory certainty. If the laws are changing every couple of years, then it makes it very difficult for investors to get comfortable in investing in what is essentially a very capital intensive and long-term project before they start seeing any returns. The second point, I'm not going to read the whole one to you or the whole paragraph to you, but effectively what it's saying is that the host government should act in a way which is consistent with international norms and standards, and should uphold the rule of law on a contracts that it enters into, and generally follow best practice when it comes to enforcing contracts and expropriation and things that could have an effect on investment. And lastly is the fiscal system. It needs to be consistent with the overall economic and fiscal objectives and a fair sharing of the financial benefits. And I think what's important to understand from an investor perspective is that they won't merely look at the taxes that apply to mining. They will look at the entire fiscal basket. So we're going to look at income or corporate tax. So look at the fiscal policy or the fiscal basket as a whole, and they'll make their decisions based on that. So these were these 8 principles that the OECD came up with to create effectively what is a level playing field, and to make sure that investors have front of mind all stakeholders, so not investors, but the parties have all stakeholders in mind when negotiating these contracts. Are there any questions on that before I move on to the private agreements?
I would say the principles look good. In a general sense, Patrick, the devil is in the detail, as they say.
No, absolutely. So these look great on paper, but when it actually comes to negotiating, you want to make sure everyone adheres to these principles. It's no good one party adhering to them and the other doesn't. So moving on to private agreements. So those were effectively your government contracts that normally occur in the sort of MDA concession environment. And these are your private agreements where effectively, what I mean by private is private between 2 private parties, the mining company and a third party. These will occur both in the licensing regime as well as the government contract regime. And these are particular to the mining operations. So whilst there are a plethora of agreements that may be entered into, I thought I'd just highlight some of the key contracts that we at least see in the context of a mining operation. So you've got a contract mining agreement where effectively you've got your holder of your license, and they don't necessarily have all the equipment and employees, and you've got really specialist mining contractor outfits who will literally come on site, and they will mine, and for their mine services they are paid a fee for performing those mine agreements, and often it even includes the sort of rehabilitation of the mine when it's come to the end of the life of mine. So those are very normally lengthy agreements, but also heavily negotiated agreements given the importance and nature of those agreements. You've also got offtake agreements. Offtake agreements are effectively when a third party, let's say such as a trader like Glencore or Trafigura, will come along and they will buy the production or portion of a production of a mining company over a certain period of time. It's also a way of mining companies obtain funding for the development of their mines. So what that's normally called is a prepay and offtake agreement, where effectively the third party will pay the mining company upfront for the offtake over a period of time. The mining company will use that money to effectively develop its mine or for whatever it needs that money for. You also get toll treatments agreements, and that's normally in relation to when you have one party with a beneficiation or a gold refinery, and it agrees to treat ore delivered by mining companies and effectively produce a beneficiated project, whether it's gold doré or refined bars or beneficiated coal, whatever it might be. Land use and occupation agreements, again, this is where you have a situation where you enter into a land agreement which allows you access to private land between the mining company and the landowner. If I give you a South African example, the mining code in South Africa, the MPRDA, effectively gives the landowner, the license holder, a statutory right of access to that land. So the landowner cannot prohibit the mining company from entering the land and conducting mining on it. The mining company simply has to compensate the landowner for any losses. But what invariably happens is that the mining company effectively enters into this type of agreement with the landowner just to make sure that it's well regulated and that there are no issues along the line. And then you've got your general service and supply agreements that mining company enters into with their suppliers, and infrastructure agreements in relation to your EPC contracts and things like that for the installation of infrastructure. So that's a very brief description of some of your private agreements in the mining sector, and there's no real standard for negotiating these. These are sort of normally done at arm's length and between 2 private parties, and they're normally market standards for these type of agreements that mining companies and the service providers tend to follow. So that brings me to the conclusion of my section. I was wondering if there are any questions before handing over to my ESG colleagues, who will talk to you about the importance of ESG generally, and also in relation to negotiating these contracts.
You know, I had a general question. I guess we can get into it later as well, but a lot of these agreements have very generalized terms in terms of like a royalty of 7%. But the critical thing is, what does the transfer pricing apply to? And is there a separate agreement or sub-agreement that gets into that kind of issue, Patrick?
Yeah, so look, normally I would lean on my tax colleagues for that kind of advice. But I mean, what we generally see, so if you take South Africa, for example, in the mining licenses that are issued, it specifically says that a term and condition of this license is that all minerals that are sold by the holder of this mining right must be sold at market-related prices. Now, I get that's very broad, but probably purposely broad. So what that effectively does is it gives the regulator the ability. So if, for example, a mining company looked to sell its product offshore at a trading house in Singapore at below cost on the basis it makes its profit offshore, the regulator can step in and actually ask for copies of those invoices, copies of those any sale agreements and things like that, to ensure that there is effectively not transfer pricing, and that those the minerals are being sold to that trading company at an arm's length market-related price. And a failure to do so, it then constitutes a breach of your license, which can lead to termination. So that's what we see in the sort of South African context.
Yeah, I just wondered if there's a separate agreement on the determination of the, you know, that's a fairly broad standard, and it leaves the government in position of, you know, enforcing it, which is fine. It has both advantages and disadvantages to the company, I guess, and the same thing with the government. I don't know, Michael Durst, I don't know if you have a question or comment in that area. That's your area.
Yeah, I think what often happens is that those kinds of clauses in basically a commitment to abide by the arm's length standard leave so much uncertainty that conflicts are fairly common between the tax authorities and the company. For example, you do rely on posted prices perhaps for gold at a particular stage of processing, or oil, or whatever. But the price of the product from a particular mine is heavily influenced by the impurities and other elements of product quality of the particular mine. And so there are a lot of very substantial adjustments that need to be made to the posted price in order to come up with the arm's length price. And that area has notoriously been unsatisfactory. There are very technical issues, and they often pit a well-financed company against a resource-constrained tax authority. And so it's an area of regulation in the extractive sector that remains unsolved, I think, is a fair way to put it.
Yeah, Viola has a comment as well, I think, or a question.
Yes, a quick comment to say that there are some developing countries right now who are now developing transfer pricing regulations. Sierra Leone is the latest. I think their regulations went public either this year or late last year. But we also have development organizations, one of them being the African Tax Administration Forum in South Africa, where they develop toolkits for transfer pricing, and they even have recommendations for African countries on how to draft transfer pricing regulations.
Okay, fair enough. Anybody else have a question or comment? Forge ahead, Patrick.
Thanks, John, and thanks, Viola and Michael, for the input. That's very, very interesting. Okay, Justine, over to you.
Sorry, the inevitable inability to find the mute button. Here we go. Yeah, so I'm not going to take up a lot of your time. What I should tell you is that we've included a number of slides at the back of this pack, which will be shared with you, and which I suggest if you have an interest in ESG, which you read. So I really just want to give you a very high level overview. In terms of understanding what is ESG, and I'm sure Ernst will jump in here in terms of giving some of the history behind it. But for me, ESG, or environmental social governance, are criteria or a set of standards that are applied by socially sort of conscious investors to screen potential investors or investments. What I think we need to understand is that it's no longer simply an investor question. It's now being implemented across the board, and all sorts of companies and things like that are looking at it. So if we look at the various buckets or criteria that fall under ESG, the environmental bucket includes everything from cleanhouse, climate change and greenhouse gases, to air and water pollution. On the social side, there are human rights and health and safety concerns. And in the governance bucket, we see things like executive pay, bribery and corruption, data protection. And I think for those of you who are familiar with the mining environment, you will be able to see that 100%, most of these already apply in the context of mining, and that's why ESG is so important to consider in the extractive industry. I see Ernst has come on camera, so I'm assuming he wants to chip in here.
Thank you, Justine. Not necessarily. I see we've got a bit of feedback. Justine and I are sitting on opposite sides of the same office, so please tell me if you're getting the same feedback that we're getting. But I think the only point that I would make is that the E, S, and G boxes are artificial or man-made constructs. So it's not necessarily important to try and put things in specific boxes, as long as we understand that the outcome or the purpose of this exercise is to identify specific issues which can affect the long-term sustainability and viability of a business. So the easiest example, I think, to illustrate this is pollution. Pollution is something that we face often in the extractive space, and at first blush, because it is contaminants that affect the soil or the air or the water, we would put that in an environmental box. As soon as the pollution starts affecting local communities or even the health and safety of workers, of course, that then spills into the social bit. And then once we start investigating whether or not the company in the extractive space has a policy in place to manage waste properly and environmental management practices, that's a governance question. So I think it's an easy example to illustrate how quickly these things overlap. At the same time, it's helpful to have these three boxes because it helps us compartmentalize the different issues that we should be looking out for as we go about the daily business activities in the extractive space.
Yeah, I have one brief comment. This area has become a hot button for financial reporting. And I guess I'll just leave it there, but the whole standards are evolving, and what you report and how you report it is quite a current topical issue.
100%. And I think what we need to appreciate is that what you report and how you report is from a legal perspective, the biggest hot potato, because we are finding that people are misreporting, underreporting, all sorts of things. And that's where the whole argument regarding greenwashing comes in. We've seen some quite interesting developments in the SEC space in the United States, where people have actually been taken to task by the SEC for failing to provide adequate information, etc. So I think from a corporate perspective, it's significant. But what I wanted to make clear is that my view is that ESG is applicable both from a corporate perspective, but also from a government perspective. I do understand that we can't necessarily require governments to report on all sorts of criteria, although they are obviously doing so in the climate change space in terms of greenhouse gases, etc. But we do need to appreciate that governments which, for example, have poor human rights tracks records, etc., are not going to be attractive to investors and mining companies who are sort of abiding ESG principles and practices. And that's where I think it's important that we apply it in terms of both parties from a mining contract perspective. If we could move to the next slide, please, Ernst.
Rachel
This
had a
is really
question.
just a honeycomb of all the sort of ESG issues that might be applicable. Bear in mind that, you know, there's a lot on this slide, and many of which are applicable to the mining context. But what I think we need to appreciate is that it often goes far further than this. So just see this as a brief snapshot of the kind of considerations that fall under ESG. And I think we need to appreciate that it's only going to grow. So if I'm going to use a little bit of a TWE example, we'll say that this honeycomb is going to become a full-on beehive in future. If we could move to the next slide. This is very much focused on corporates and why ESG is important. But from my perspective, I think apart from what we've included on the slide, it's important for us to appreciate that ESG informs how we should all be doing business. It's a way which balances the rights of stakeholders and finds a mutually beneficial solution to all. And if you ask me, I think that what we're really doing in terms of looking at applying ESG principles in the mining context is we're extending the OECD principles and the ideas underpinning those, which Patrick is already speaking to. It obviously helps apply and mitigate risk and ensure the continued social license to operate. And I think for those in the mining context, we all know that if you don't have your social license to operate, it's tickets. I mean, non-compliance is one thing, but absence of social license to operate is another story. So from my perspective, I think we can all agree that it's more than just a framework that financial institutions and investors have to report on. It's on the radar of employees, regulators, and everybody involved in the mining ecosystem. I think we need to appreciate that communities are probably the most impacted and the ones that we need to be looking out for, in addition to investors, etc. So if we could move to the next slide, please, Ernst. I put this slide together because I want you to understand how ESG fits into a contract, a mining contract discussion. So if we look at more advanced mining jurisdictions, we know that they have mining and environmental permit applications. And as part of those applications, there's generally some form of due diligence exercise that is conducted. You submit an environmental impact assessment report. You might submit your financial abilities and technical competence. In South Africa, you would have to submit a social and labor plan. Those are all things which ultimately aim to give effect to ESG principles and criteria. However, in mining contract scenarios, you might not have that benefit. And the suggestion from my side would be that any contractual arrangements should be informed by appropriate due diligence by both parties. It's important that you know who you're dealing with. And when I say both parties, I go back to what I said about certain countries having poor human rights track records and the reputational and ESG related impacts that might have on countries who choose to do business in those countries. And that's obviously something that you might find out when you're doing your due diligence exercise. Then one would incorporate appropriate ESG contractual undertakings and protections for both parties as far as is possible. I do appreciate that in the context of government entities, it's quite difficult to require that they, for example, don't commit human rights infringements, etc. And lastly, it's a good opportunity to use the contract as a way to meet policy objectives and goals. So, for example, in the climate change context, we might have nationally determined contributions from a GHG perspective, which you could sort of carry through into the agreements in terms of commitments that a mining company is required to meet, and enabling the country itself in meeting its UNDCs. I should just point out that there are a number of recent examples in the United States and in the UK where the laws are changing to require ESG principles and criteria are incorporated into procurement contracts that are concluded by government. And from my perspective, I see no reason why this wouldn't start extending to mining contracts. So from I would suggest that you start thinking of mining contracts as investments, just in terms of investing in the country, investing in the people, and therefore applying the same principles and criteria that financial institutions would have adopted. So that's everything from my perspective. I don't know whether there are any questions or if Ernst wants to jump in. I know he always has good things to say.
I think Justine hit the nail on the head here, but I would be very interested to hear what the students and the participants have to say about ESG, because a lot of the developments in the ESG space are driven by millennials, people who fit into our cohort of life and who have strong views about environmental issues, about climate change issues, because we realize that we need to tackle them in 2 or 3 decades from now. It's very easy for a 60 or 70-year-old CEO to make commitments to reduce carbon emissions when for 2050, when chances are they won't be practicing at that stage anymore. So yes, any questions or comments are very much welcome, because this is I suppose our generation stamp on what the business world, how the business world at least should change.
Yeah, I guess to kick things off, and people can ask their own questions, and I'm hardly a millennial. I'm well past a post-millennial, whatever the term should be. But you hear all the talk about ESG, which is great. But when it comes to private industries, I must admit, I'm a bit of a skeptic sometimes about the actual commitment of private firms to ESG standards. And I surely understand that there are firms that are quite committed to it, but there's a skepticism in my mind about it. And I came out of the corporate world, so it's not like I've never been involved with it. I've spent a good part of my working life with it. But I don't know what other people think, if people want to comment on it at this point.
Well, I just wanted to say I fully hear your skepticism, but I think as we see more enforcement for false statements coming out, it may mean that it actually starts to take shape and becomes a reality in many spaces, and no longer just a nice to have.
Can I maybe before Lazola comes in, I just wanted to say, from a practical perspective, John, there are real world examples of where companies, by hook or by crook, are changing. And I think one of the best examples for me is Tesla. Everybody in this call is obviously very familiar with the child labor issues in the mining of cobalt. And Tesla didn't want to get involved in that battle, so they developed a battery that works on nickel and hydrogen. And because Tesla is the world's biggest manufacturer of electric vehicles, that meant that companies in the mining space that weren't able to address child labor issues, which is obviously an S issue, and can guarantee that the cobalt that they mined is free from child labor issues, resulted in them losing the business that they could have had with Tesla. So I think if you want to, you can change because the law whips you to change, or you can change because society expects of you to change. It's a business decision how quickly you change. Lizola, the floor is yours.
Thanks, Ernst. I was actually just about to write it in the chat, but then I couldn't remember if it was on Monday or on Tuesday, where you spoke about the training or the suggestions that you had to this kingdom of Saudi Arabia, of including making local content, not something that would be in the legislation, but something that companies would have to put in their mining applications, and then making that sort of like a condition as to whether or not you're granted the license. And I think a similar approach might work for ESG. I think it's very possible that if that's the way in which we're going, that the onus should be on the company and not on the government to prescribe what companies should commit in this regard. I mean, there has been research that is coming out from large investment houses like BlackRock and what's the other one? Makita or something like that is the other one's name. But yeah, these large investment houses are releasing their reports, and they've been showing that actually companies that employ ESG in their governance structures, and companies that are moving away or divesting out of fossil fuels seem to be making larger returns in recent years than companies that are, not. So I do think that there's a strong business argument for it, in addition to the moral argument.
I wish I could work out where the clapping hands emoticon is, because I'm totally on your page, and I think you're spot on.
Okay, let's move on.
John, from our side, this is what we plan to cover today. I'll share the slides with you, and you can share it with the participants after the lecture. As Justine mentioned, we've prepared some slides that are available for background information purposes. That focuses on some of the things that we sit with clients on in the ESG space. So if we think about directors' duties, how would you factor that into your business model? But also then that would feed into Patrick's side of the work, where who are the suppliers with which you should can engage, what are the due diligence processes that you must follow before you enter into agreements with suppliers. In your concession agreements with governments, what are the things that you should undertake to do, and where does the boundary lie between being a good corporate citizen and actually taking on specific government functions, which is something that Patrick does a lot for clients, talking about the social and labor plan space and what they should and shouldn't do. Somehow this slide highlights a little bit about the allocation of risk and responsibility and things that companies should think about. Justine briefly spoke about the different pieces of legislation and standards that companies are considering in the extractive space. And then some other key issues, of course, the social license issue and engaging with local communities, diversity and inclusion requirements, something that in Africa, I think we are leading on in comparison to what the rest of the world is doing in the diversity space. Human rights issues, we spoke about that briefly as well. The decarbonization processes the company must follow, tailings management, which is a hot topic in South Africa for the last 2 weeks after the Jagersfontein tailings dam failure, water management, again, a big issue in Africa, of course, governance, how do you, when you incorporate representations and warranties in your agreements, what should you say, what shouldn't you say, this is just a starter, of course. Reporting, we also briefly spoke about, transparency practices, what it is that you should think about pursuing. And then in the end, how do you manage your ESG risk? Again, like the presentation when Peace and I delivered at the start of the week, the focus for us is generally more from a private sector perspective because of the clients who we advise, generally speaking. But as Justine also mentioned, at the end of the day, when it comes to ESG issues, we are all participants in a greater ecosystem, and governments and private sector participants and communities, when they make movements in this space, their movements will have as Newton would have said, an equal but opposite effect on the other parties. Yeah, so we'll share the slides with the rest of the team, but I think from HSF's side, this is what we plan to cover on a Friday afternoon.
No, that's great, Ernst. You went, there's a comment in the chat box. You wheeled through those slides, some of which seem to be fairly interesting fairly quickly. We do have time, but you're going to make the slides available. You can send them to me and I can send them out, or I can send you the list of participants, and you can send them directly. We can sort them out afterwards, but I will say the slides that you wheeled through seem like they have a fair amount of useful information on them. So I would encourage people to look at them after our course is concluded. We have a chance now. We actually are a little ahead of time, but we have a chance now to open up questions to HSF and to Viola on, frankly, the whole course. And I must admit, I jotted down a variety of questions that seemed significant to me. And so I'm happy to start off. Michael, you may have some questions as well. And some of these questions, frankly, aren't things that we discussed today. They relate back to earlier discussions, but I think they're kind of interesting to talk about. So since this is a course on taxation, let me start with a question on taxation. It's not in particularly intricate matter, but a lot of the concession agreements, whatever you want to call them, contracts, have tax incentives in the form of tax holidays. And the holidays, typically the ones I've seen, extend for 10 years, and then maybe there's a reduced rate of tax for another 10 or 15 years. And, you get into the whole issue here of incentives and the value of them and what form they should take. But I'd be curious what Viola and what HSF people think about incentives in general and their value, and secondarily, is a tax holiday a good form of an incentive? So let me just open it up. I'm sure, at least I believe, participants will have questions, and I'm certain Michael will as well. So who would like to handle that? Nobody's volunteering.
I can mention a few things on tax incentives.
Okay.
Yeah, and I think at the end, I'll also share a practice note that IGF developed on tax incentives, specifically in the mining sector. So one of the things that we start with is our tax incentives. Before you even go to, okay, is it a tax holiday? Is it a royalty reduction? Is it a VAT exemption? Is why do we give tax incentives in the mining sector? So a lot of the reasons is we give tax incentives to attract foreign direct investments. And then the key question is, has it achieved that? And is it useful for the mining sector? So one thing you have noticed about the mining sector, that it is location specific, that I can't move this resource from Kenya to Uganda where I'm given tax incentives. And looking at what investors, I think it's probably, again, the Fraser, the survey that was done by the Fraser Institute is asking private investors, what is the first thing that you look at when you go into a country? So we all have to agree that it is the geology. The geology, it's the oil being in Kenya that will bring investors into Kenya. Not to say that tax incentives are not important. They look at the tax structure, not even really tax incentive, generally tax in structures, approvals process, stability, political climate. They look at all these other things. But one thing that we say about incentives is in the mining sector, it's not as responsive as compared to the other sectors. First being that the mining sector is location specific, that you can't move the resource to countries that are given better tax treatments or incentives. So for that reason, that the mining sector is location specific, makes incentives very less responsive in the mining sector. But then we go ahead and say, okay, the mining sector has very huge capital outlays and the costs are very high. That's why you probably require debt and equity to finance these constructions and all this. So we understand that if a country is to give incentives, there are incentives that are better suited given to the mining countries, and these are cost-based incentives, as opposed to the profit-based incentives where we put corporate income tax holiday under. So cost-based incentives are incentives that will help investors recoup their capital expenditures faster. It does not reduce what the government gets, but what it does, it helps something like a accelerated loss carry forward, accelerated depreciation. So just to note that depreciation, loss carry forward are not tax incentive, but if you accelerate them, then they become incentives. So those ones make investors recoup their capital expenses faster and then push what government gets in terms of revenue later. So that's why we say if you want to give incentives, consider cost-based incentives. On the other hand, we did a survey and a lot of governments give corporate income tax holidays. So how does that play out? So first of all, it does not make sense, but because when you look at the profit-based incentives, they incentivize, they're meant to incentivize the marginal mines, but it really does not. It's the company that's making more profits. They get to keep a lot of their profits because you've given them corporate income tax. The marginal mines, they're not making profits. So, but then when you give them a corporate income tax holiday, it's pointless because we're already not making enough profits. When you give us profits means, okay, there's nothing also, in any case, there's nothing really to tax. So why the profit, why the corporate income tax holiday? But also another thing that, and this is the final point, is on the aggressive behavior. So we say you have to be careful that these incentives can be distorted by investors. And this is what we call behavioral response. So for example, if you give a corporate income tax holiday to an investor, the first thing that they'll think about is, and not all, the first thing that they'll think about, how can we make the most use out of this incentive? So if you give a corporate income tax holiday of 5 years, one of the behavioral response is to try as much as possible to extract the high quality or as much as possible in those 5 years when they're not going to pay corporate income tax. So because that's when there's a holiday, and then now after the 5 years or after the timeline has lapsed for the holiday, they tell you, oh no, actually we produced what we needed to produce. We want to terminate the contract right now. And we've seen examples like in Malawi, we've seen countries, investors who've done that. So for us, it's why you're giving incentives, and if you are to give, which ones are better suited for the mining sector than the others. Thank you.
Justine thank you very much, Viola. Justine had a question. Do you see ESG incentives? And if so, what form do they take?
Actually, that's a good question and a good conversation that we're currently now looking at. If there's a place for incentives, can we use, for example, incentives right now with climate change can we use incentives for value addition and not use it for upstream? Can you use it for value addition? Can we use to enhance, for example, to encourage companies that are now using technology that are resistant to climate change? Can we use incentives? How can we use incentives in a way that's going to enhance the ESG, climate change, energy transition conversation? So that's something big that's currently happening. And I think also UNECA, the African Union, are currently having such discussions.
HSF, did you want to jump in here on some of these things? Ernst, something
John,
else?
I think Viola's summed it up very well on the ESG side. I was just going to talk more generally to sort of, and then perhaps Justine, I think you were going to say something, but just more generally on sort of incentives and not necessarily limited tax incentives. I think that what we like to call the stick versus the carrot approach. And I think we've seen that from, let's take, for example, I think it was Indonesia a number of years ago. They were trying to create a downstream beneficiation industry. And what they effectively did is ban the export, the complete entire ban on the export of any unbeneficiated products mined in or minerals mined in Indonesia. And I think they quickly reversed that after 2 or 3 years when they realized that it effectively dried up all investment into the mining space. And so that was sort of your stick approach. Whereas we found in other jurisdictions, incentive-based approaches around, let's say, paying a lower royalty on beneficiated projects, at least in our experience, has had a far better, that incentive-based has had a far greater effect on drawing investment and creating that downstream industry. And another one is kind of forcing mining companies to list in various jurisdictions, which, delisting can become quite difficult in those circumstances. There's also liquidity issues as far as trading of shares. And so generally what we've seen is investors react far better to incentive-based schemes rather than sort of your stick approach. Justine, sorry, I think I interrupted you.
No problem at all. I mean, I was really just going to be very enthusiastic about what Viola was saying is a forthcoming attraction, and tell John that seeing this will hopefully give him some insight into the fact that ESG is going to become a real thing. I did wonder whether or not there's been any discussion on carbon tax, and appreciating that in some countries, for example, in South Africa, where the rate of tax is very low, it might indirectly represent some kind of incentive, although it would be a fairly sick incentive.
Yeah, it's funny, we haven't gotten into carbon taxation at all. And Ernst probably will appreciate this. When you get into green hydrogen production, I forget the exact term, but the terminology is that there is, in fact, an incentive given to all carbon intensive industries because they aren't charged for the carbon emissions that they emit, that they make. And so then the question is, how do you equalize if they get, in effect, a hidden incentive? How do you equalize that? Do you give tax credits or some other form of incentive to electric car companies or other companies that are working in a environmentally friendly fashion? Carbon taxes are vastly unpopular, and they are, they hit the lower class people heavily hard. But we haven't really talked about carbon taxation, and probably should have during the course. Michael, did you have some questions? I have a couple other questions, but I don't want to take up every.
I was just going to offer a thought on tax incentives. And, you know, really in industry generally, say in manufacturing, one of the main drivers, maybe the main driver of tax incentives is tax competition. Basically, the country feels it needs to offer a tax holiday, a very low tax rate, in order to induce an investor to open a factory in its country rather than in a neighboring country. That is generally felt, as Viola was saying, to be less of a concern in the extractive sector, because the pool of countries competing for investment really is limited to those with a particular mineral resource. I mean, if a mining company is thinking of opening up a new iron mine, there are only a few countries from which it can choose. And so you would think that tax competition is less of a problem, less of a motivating force for incentives in the extractive sector than in the industry generally. I'm wondering, and this may well have been done, and I might just not be aware of it. It would be interesting to learn how strong a factor, how important a factor tax competition is in the extractive sector. Even if there are only, say, 2 or 3 countries with the deposits that are being sought, and so only 2 or 3 countries that are competing against one another to attract investment, is that enough to induce the kinds of excessive tax incentives that we see elsewhere? I just don't know. It's an empirical question, and it would be interesting to learn. Maybe Viola, you're aware of some studies on this, and if there aren't such studies, I think they should be done. It'll help us understand a bit more about what we're up against when we see companies, even in the extractive sector, offering tax incentives that on their face seem more generous than are necessary to provide the investor with an acceptable return on investment. But nonetheless, countries offer these incentives. And I'm wondering, maybe Viola, if you can offer some insight into the extent of tax competition in the extractive sector.
Thanks, Michael. Justine's hand is up. I'll let her speak and then I'll just give a quick comment.
No. I will wait for you, Viola. Yours is a direct question. Mine is an ancillary point.
Okay, thanks. Just to quickly answer, Michael, yes, no, we don't have so much literature on that, but we have one good example in West Africa. So where there was tax competition between countries, and what it resulted for, and this was specifically for gold, that it ended up resulting in smuggling of gold. And there's literature written on that now gold was being smuggled into countries that have the incentive. And one of the things we advise countries, you start with this tax competition, you go into this race to the bottom where it really doesn't help you. And now with the global minimum reforms, and now it's pointless to have, we'll have to see some incentives not even making sense, that yes, there's no really point of having these incentives. But we have this good case in West Africa that we use a lot on how the tax competition encourages the smuggling of gold. And I think the West African Union standardized then the taxes.
You know, we did have a discussion about Pillar 2 and the minimum tax and the impact on developing countries. Justine, go ahead, please.
I really just wanted to say I appreciate that this course is about taxation in the mining industry, but I would very much encourage us to encourage investors to look beyond taxation as the only kind of cherry in terms of choosing where you want to invest. We need to stop looking at money. And I know I may sound like a little bit of a hippie here, but I feel I'm entitled to in my capacity as the ESG representative on this call.
You're
Let's say
very millennial as for a group of high-powered corporate lawyers.
Very, very millennial for somebody who's in fact a zennial.
I see. I see.
Okay, I'm not even sure what that means, but we have different terms for different generations. I had another area that I wanted to get the opinion of people on, but before I interject myself again, did any of the participants have a question they want to raise? If so, please raise your hand or put it in the chat box. Well, let me raise my issue, and then people can give some thought to it and raise questions if they'd like to do so. We do have a few minutes. One of the things that seems to have become controversial are these stabilization clauses, and in particular their combination with arbitration, where any disputes that arise, whether it be under a stabilization clause or more generally, is taken to arbitration, and the arbitration takes place outside of the country, out of the control of the developing country. And so I wonder what Viola and HSF people think about arbitration clauses and stabilization clauses. And this is not a public record.
Viola, do you want to go first and we can follow?
I'll let the lawyers go before the economist. Mine actually, my comment on that, I would actually probably relate it to incentives. Again, what we've noticed, and this conversation of OECD Pillar 2 is now you have these incentives, you've realized it's not necessary, but then you can't remove them because you have stabilization clauses. What do you do? So that was my only comment, and see, it's from an economist point of view. So I'll let you.
I will say, Viola, we got into that. The developing countries are stuck because they gave the incentive. They'd like to get rid of it. The minimum tax is going to be imposed and collected by the parent company jurisdiction. And so they say, I'm stuck with my stabilization clause. If I try to get rid of it, I'm sucked into arbitration. And in any event, I don't know, Patrick, other people from HSF.
Johnny, I mean, it's a very good question. You know, an issue that, I mean, as I sort of mentioned, is that you're looking to conclude these agreements at a time and hope that in 10, 15, 30 years time that they're still relevant and applicable and still up to date with the laws and things like that. And, you know, more than often they're not. So investors will obviously push incredibly hard for these clauses because, you know, they want that certainty. And yeah, and then they also push hard for because they know very well that, you know, if it's subject to local arbitration or the local courts, that they may not get the enforcement of, or they may not be successful in the enforcement of that stabilization clause, as it may not at the time be aligned with the country's objectives or narrative at the time. So it's a constant battle when it comes to negotiating these clauses. And I think, you know, that is the difficulty, is that investors want stability, but at the same time, you've got to have some sort of flexibility around a contract that's effectively going to last for 30 years.
Yeah, you do see countries, I guess, I don't notice this so much with African countries or smaller developing countries, but the arbitration clauses in various investment agreements and other kinds of treaties, countries are going in and taking them out. And India is, I guess, a prime example where, you know, they suffered the Vodafone, for want of a better term, debacle, I guess. It went on for years and years and years, and it just got settled for a couple $2 billion about 6 months ago. And I don't know. Do you see that happening more and more where countries are saying, we don't want these arbitration clauses, or ISDS arbitration clauses in any event. Is that a common thing, or is that just India and a few other select countries?
Vince, looks like you want to comment. Are you thinking
Yeah,
about
I can.
that? Yeah.
Tanzania, but just South Africa in general as well, Patrick. I think the ISDS clauses are generally contained in bilateral investment treaties. It's because of course it's a dispute settlement process between an investor and the state. So it's very seldom that I suppose under concession agreements you would have that as well, but then probably under concession agreements you would refer something to the UNCITRAL rule system. Whereas if we think about the standard exit, which is the World Bank's dispute resolution body processes, I think generally countries in the developed region are conscious of the way that they've been treated in the past. So South Africa, for example, for a number of regions in the years around the 2014 to 2016, terminated a number of the bilateral investment treaties with several of the European countries. And there are only a few of them that are still active in the South African space. They, of course, all have sunset clauses that mean that which means that they remain active and enforceable against investments which were made prior to the termination date of the specific BIT, and that also continue to protect these investments for periods ranging from 10 to 20 years. Some of the motivation that they gave then speak to what it is that you're saying right now, John, is that and this is something that we spoke about often with the Green Hydrogen Organization as well, is I think African countries are very conscious of the colonial past that has imposed a number of draconian measures on them. And a lot of things nowadays, a lot of processes focus on scenarios where we find Africa palatable solutions to problems. So, for example, where in the past you would have a dispute between an African country and a private investor, and the dispute would be resolved in London or in Singapore. That's I think there are better solutions for that, like referring disputes to Mauritius as an example of an African-based seat, or Arusha in Tanzania, for example, is also quite a popular seat. Egypt is a popular seat as well. And then, of course, our own Arbitration Foundation of Southern Africa, or AFSA in Johannesburg, is an increasingly popular seat. So, sorry, I'm saying a lot of things, but I think the first thing important to make is that, yes, there is definitely, like India, as we saw with the Kingdom of Saudi Arabia as well, after the oil disputes that they had in the 70s, there's a strong move away from a European, a Eurocentric, or an American-centric, or a Western-centric approach, and the focus is on an Afrocentric process to dispute resolution for Africans by Africans. The second bit then is to understand that, yes, I don't think that necessarily investors are completely out in the woods and that there's no recourse to international arbitration, but it has to be an African-focused arbitration. So have a seat in Africa. And I think once you change the way that you approach this, as in not with wearing your traditional exit hat, and you said that Africans are in fact capable of resolving their own disputes at their own seats in the continent, then you appreciate that you can still have access to third-party arbitration mechanisms, which ought to, let me rather say, give investors the confidence that disputes can be resolved by competent jurists. Does that answer your question?
Yes, indeed. That's very helpful, Ernst. Okay, we're about 15 minutes earlier than I thought we would be, but let me open it up. There is one hand up. Lynette has her hand up. So Lynette, why don't you
No,
go ahead
just,
and ask your
John,
question?
just a quick question. I was
Sure.
trying to, you made the point about India pulling out. Are you referring to existing contracts, or do you mean that they've decided to take a different approach?
No, what I meant, well, the Vodafone question, not the whole thing was that India, well, let me back up. The company argued that India enacted a retroactive law that's subject to tax. And so it ended up in arbitration. First, it went to the Indian courts and the India courts, which frankly, what precipitated the legislation was the courts sided in favor of Vodafone, and the legislation came in after the fact, at least from one point of view. In any event, it ended up in arbitration, several rounds of arbitration, and finally India agreed to a settlement. But what I was referring to was the fact that given that history, India decided that it really did not want arbitration agreements in its investment agreements, its treaties. And so they've taken it upon themselves to get rid of them. I gather South Africa has as well. And I suspect there's some other countries doing that as well. You know, it kind of depends on the arbitration, as Ernst said. If in Africa there's movement to solve issues in the continent and not have them taken, you know, someplace else in international panels outside of Africa. But it is a hot button topic.
Can I
So-
just ask a
Sure.
follow-up then to,
Sure.
because there was mention of African arbitration for Africa. You know, how would that look different from, you know, going to a European seat?
Orange can
Or
do that.
So, no problem. I think it's about perception in the first instance, Lynette. I think there are two very important components to this for Africa by Africa. The first is an African seat. So not to have to fly from your mine in the Democratic Republic of the Congo to Geneva in Switzerland to have your dispute resolved there. There's no reason why you can't just fly to Arusha and have your dispute resolved there. If you wanted to be fancy, I suppose you could even go to Mauritius. And then the second thing is the arbitral panel, the composition of the arbitral panel. To not have, and I'm saying this tongue in cheek because I fall squarely in that box, but not to have an all pale, all male panel of three resolving your disputes, but to acknowledge that there are African arbiters who are as competent, if not better suited, to understand the nuances of the issues that gave rise to the dispute in an African context, and then to help find an acceptable African solution to the dispute. Does that give you some sense of what Africa for Africa by Africa I'm hinting at?
Yes.
Good.
Yes, thanks.
Okay, anybody else have a comment or a question? Michael, did you have any final thoughts?
No, I've been thinking a good deal about the presentation we just heard on ESG, and one can argue that why should these principles be voluntary? Why should they be non-binding? Why shouldn't they be enshrined in contained in binding legislation around the world? And of course, in many cases, maybe all cases, they should be, but we're a long way from that as a practical matter. And I've been very impressed, and I'm hardly a millennial. I'm like John. I'm a post-millennial, and I have also, like John, have a private sector background, so I tend maybe to be a little hard-nosed about such things. But I think that there's been an amazing progress made by through the agreement among companies, all of whom, the personnel of which I think want to do the right thing. I mean, no one wants in his or her job to be doing things that they perceive as wrong. And I think that really it's the personnel of companies to a large extent who have provided standards by which public discussion and public disclosure by NGOs perhaps can be a very effective force for change. And I've been surprised at how pleasantly surprised at how firmly ESG, and there's a group in the tax field called the B team, which is essentially an ESG operation, and that has some exposure to them. I think it's a very promising development, and I would encourage all you millennials who are putting energy into it to keep doing so. I think it's, and I really appreciate the presentation we had today on it. It was quite helpful.
Yeah, Justine's not a millennial. She's a centennial. I don't, some other term. They keep coming up with terms.
Well, we're all millennials. We're all millennials at heart, right?
Yes, but Michael, I think you raise a very good point. A lot of employers' actions are now being driven by employees who insist on them adopting sort of ESG values and principles in terms of how they operate, because they will basically not work for companies who don't prescribe to the values that they prescribe to personally. I mean, and
Okay.
I know as a Zennial, there are clients that I simply refuse to work for. And that's very interesting coming from a lawyer, I'm sure.
Okay, fair enough. I would like to thank all of today's speakers. We really enjoyed the discussion, Viola. Let's see, and we had Patrick and Justine. We did not hear from William. I don't think we certainly heard from Ernst. So thank you very much, HSF people. I thought your slides and presentation was great. Similarly, Viola, thank you so much for participating with us. And I will say to the participants, Michael and I, we started out the week, we had, I would say, a fair amount of trepidation about how it would go. And I don't know whether you're happy, but we've been quite happy with the presentations that were made, and frankly, with the participation of the people in the course. So that, I think, makes the presenters finding it much more interesting and rewarding to do so. So thank you, everybody. We really enjoyed doing the course and having you along with us during the course of the week, and maybe sometime in the future we can do it again. So I don't know. Thanks, everybody. Michael, you want to say any salutation before we leave?
Yes, thank you. It's been a wonderful week, and I've enjoyed everyone's contributions and company during this process.
Okay, I hope we can all get together again. Bye-bye, everybody.
Thanks very much. Thanks for having us.
Thank you.
Okay.
Thank you, everybody. Bye-bye.
All right.
Bye.
Bye-bye.
Thank you. Bye-bye.